Alrighty folks, today is going to be a deep dive into the heavy equipment bonus depreciation tax strategy, where instead of paying dollars to the IRS, giving more money to the government than you have to in the form of taxes, you can instead allocate those dollars or a portion of those dollars to a tax strategy such as the purchase of an asset like heavy equipment. We're going to break down every aspect of this as clearly as possible. That way, if you're interested in moving forward or having further discussions, our meeting will be more of a Q&A rather than a full-on presentation. We can sort of expedite the process given the timeline we have if you'd like to do this for 2025. Let's jump into it. To sum up the tax strategy of heavy equipment purchasing and leasing, the goal is that every $1 invested into the use of heavy equipment saves about $1 to $2 in taxes you would have otherwise paid to the government or the IRS. Before we jump into how the strategy works, if we are using this for 2025, we've got less than 60 days to have the strategy fully complete. The deadline set by the IRS is that if you want the write-off for 2025, you have to have the write-off completed within the year of 2025. In order to be wrapped up by December 31st, we need to begin setting up the strategy around December 1st or before. This particular strategy is set up by our partners, Wilson Hand. They are a tax attorney law firm based in Salt Lake City, Utah. They created this strategy that uses bonus depreciation to write off your income through the purchase of heavy equipment. The purpose is to spend $1 on an asset to save $2 to the IRS. This is just an example, spending $1 to save $2. Really, it depends on your effective tax rate and whether your state allows bonus depreciation and if your state has income taxes at all. With bonus depreciation and the purchase of heavy equipment, you don't have to understand everything about how this works because this is done for you by the tax law firm. As far as you're concerned, you are investing in a business in order to avoid giving those dollars to the IRS. And because it's done for you, you don't have to learn how to purchase equipment and lease equipment and run a business. Really, the work that you need to do and the thing that you need to be considering is how much of a write-off would you like to have? Say you make $1 million and you owe $400,000 in taxes. Do you want to squash that tax bill down to zero, or would you like to squash it down so you're in a lower tax bracket? The decision is up to you. And so your role is deciding how much equipment you want to buy and coming up with the money to put down on that equipment so that you don't have to give it to the IRS. Secondly, there's something called material participation inside of this heavy equipment business that is a requirement to log and keep track of. In the very first year, you need to be considered an active participant in the business, at least on paper for the IRS in case you get audited. There's a lot of activities that we can use to come up simply with 100 hours of material participation in the first year. And outside of putting the money down on the piece of equipment, the material participation in the first year is the only requirement you actually need to complete. Let's go through an example. Let's say that your income for the year is $1 million. Nice big round number. Obviously, the higher your income, the higher your effective tax rate, and the more effective the purchase of heavy equipment to write off that income is. This income technically can be K-1, 1099, the majority of W-2, and then short-term and long-term capital gains. I will say long-term capital gains, there's actually better strategies to use outside of bonus depreciation because short-term capital gains are treated like ordinary income. It falls in the category with the K-1, the 1099, and the W-2. Going back to the $1 million of income, let's say that your effective rate, just a nice round number, is 40%. And so that tax bill at the end of the year, let's say, comes out to $400,000. The question that you're going to want to ask is, do you want to give that $400,000 to the IRS, or would you rather come up with a solution where, say, you could put a 20% down payment on a $1 million piece of equipment? Let me say that again. Instead of paying $400,000 in taxes, what if we could just put 20% down on a piece of equipment that is worth $1 million? Why would we do that? I'm not in the equipment leasing business. You're probably not in the equipment leasing business either. But because this business is run for you and you are just an investor in it, that heavy equipment purchase of $1 million counts fully against your taxable income. Let's do some math. 20% down on $1 million is $200,000. You could put $200,000 into a piece of equipment and not pay $400,000 to the IRS. It has the ability to wipe that tax bill completely. Why would the IRS allow you to have such a large write-off? If you're putting 20% down on a $1 million piece of equipment, that implies that there is a loan involved. This loan is a paper risk that we have to create to show the IRS to get a write-off. But Wilson Hand and the tax attorney team have found very creative ways to create a risk on paper to be able to show the IRS, then put several barriers between you and having any personal liability. Let's assume that on that $1 million, there's an 80% loan. That loan is by the seller of the equipment. So let's say in this example, 80% of that $1 million is financed. That loan is financed with the seller of the equipment. And the risk mitigators here is that, number one, this loan is a private loan. It's not something you have to qualify for. It's something that exists on paper. It's not reported to the credit bureaus. It doesn't affect your credit. It doesn't hinder your your ability to qualify for any loans in the future. It's a loan by the seller in order to create a paper risk to be able to show to the IRS to get the write-off on your taxes. Number two, there is no personal liability. Whenever this strategy is set up, there will be an LLC that you own, and then the LLC owns the equipment. So essentially you fund your 20% down payment into the LLC, 80% is financed. The loan resides inside of the LLC. The LLC creates a liability barrier between you and liability for the loan. Number three, there is a separate contract with the leasing company that obligates them to pay the loan. This 80% loan exists on paper as a risk so that you can get the write-off, but the tax attorney team has very creatively put multiple risk mitigators between you and any sort of liability. So like I said, technically this is a business that you're investing in. It's a business that you own, but the operations are outsourced. So the operations will be completed by a leasing company. In one of our calls, I will send you some documents so you know both who the leasing company is and who the seller of the equipment is that's financing the loan. The operations, the business will be fully handled and completed by the leasing company. The leasing company markets the equipment, they rent the equipment out, they pay for the insurance on the equipment, they service and maintain the equipment, and they collect revenue on the equipment. Now, the vast majority of that revenue goes towards both paying the loan and paying the leasing company. Now, the leasing company has very good margins in here. They're not doing this out of the goodness of their heart. They're doing this because you're purchasing a piece of equipment that they can rent, collect revenue on, pay the loan, and take a large profit. The reason why you would do this is so that you can put 20% of your income into an asset instead of paying 40% of your income to the IRS. Even if we stopped there and you had to decide between 40% to the IRS or 20% towards anything else, whether you keep it or lose it or get a return, would you rather pay 40% or 20%? Pretty simple answer. Besides the tax savings that you have, there is a target profit passed on to you of about 3 to 5% per year. Now, this depends on rental rates and the ability of the leasing company to generate a good profit. Historically, they've been able to commit to about 3 to 5% per year. So if you put in $100,000 every year, you can expect about $3,000 to $5,000 in profit, in addition to the massive tax savings you have on the front end. If this were merely an investment on its own and we weren't talking about the massive tax savings, the investment is not that great. But when we're talking about getting any return on the money that you would have otherwise paid in taxes and being able to keep an asset, it's a very kick-ass deal. So terminality, how long do you have this business for? How long do you own the equipment? Let's talk about that. There is a 10-year loan payoff on this piece of equipment. That means that the leasing company will lease it out and it takes 10 years to pay off the loan with the seller. It's not something that you have to worry about. It's something that you'll be aware of in the back of your mind. The loan will be paid off in 10 years. Now, this equipment that you're purchasing, it's not something that you get to pick, but it could technically be any sort of heavy equipment. For 2025, the equipment that you'd likely be purchasing would be telescopic boom lifts or large forklifts. Those are basically the options we have based on the supply for this year. What type of equipment it is doesn't matter, so long as you get the write-off and you get a small return. This equipment has an average 20-year lifespan. The loan is paid off in 10 years, and during the loan payoff period, you're getting a 3 to 5% return. Well, there's another 10 years that you can own this equipment and collect a return on. Now, because the loan is paid off in year 10, years 11 through 20, presumably, would have an increase in profit to you. A couple of factors, it's hard to tell you how much that increase in profit would really be, because once the loan is paid off, the equipment's also decreased in value, the rental rates likely won't be as high, and so although the profit will likely increase, it's hard to say by how much. Let's talk about, with that timeline, what are your options for wrapping up the deal once you get the write-off? So option number one, which I do think is the best option by far, is to just hold on and collect profit. You can hold on to this equipment for up to 20 years. That's the expected total lifespan. And because there's no further work you have to do after the first year, for most people, they'd say, why not just hold on to it and collect the profit? Option number two, this is for people who they get the write-off on the front end. They don't really care about the return. For them, they'd like to just focus on continuing to make more income to be able to do write-offs in the future. And they just don't want another business in the background, whether they're involved with or not, taking up real estate in their mind. So you have an option to get out of this. After 5 years, you can donate the equipment to a third party that assumes the loan and continues renting out the equipment. You're free and clear. Here's a question. Why would you donate the equipment instead of just selling it? And that's a good question. You do have the ability to sell the equipment, and that's option number three. Here's the problem though. Let's say you buy equipment for $1 million. In 5 years, you sell it for $500,000. On the $1 million when you purchase it, you get the write-off. But if you sell it again in the future, and let's say it's $500,000, that then triggers something called bonus depreciation recapture. That means that you have a new tax bill based on the future sales price when you sell the equipment. So it's not a bad deal. You get a write-off on the front end, you can sell the equipment, and you have a new tax bill, although it's lower in the future. For many people, they would rather just donate the equipment to a third party, not have to worry about any taxes. So in order from best to worst, option one, hold on to the equipment, forget about it, collect a profit until the equipment runs into the ground. Option number two, you can donate to a third party after 5 years. You're free and clear, nothing to be concerned about, nothing to worry about after that. that. Or option number 3, you can sell it at some point in the future and pay the new lower tax bill. Give 30 or 40% to the IRS, guaranteed it's a certain loss by doing nothing. Or you can pay 0% to the IRS and instead put 20% down on an asset that gives you a probable return. Let's say the worst case scenario is instead of giving 30 to 40% to the IRS, you put 20% down on an asset and the entire thing implodes. The company leasing the equipment goes under, you're not able to pay the loan, they take the equipment back, you lose the 20% down on the asset. Let's say that's the worst case scenario. You still lost 20% instead of 30 or 40% and you had the chance to get a probable return. That's your decision. 30 to 40% guaranteed or 20% that you're probably not going to lose and you're very likely going to get a return on. So this video is going to be sent out to people most interested in doing this strategy for 2025. Like I said, we have a relatively short time frame to start the process and it has to be fully completed by December 31st, 2025. Now this video does not need to be just for people interested in doing this in 2025. This can be something that if you see this video later in 2026, 2027, so long as bonus depreciation, the tax codes that we're using, section 168K and 179 of the Internal Revenue Code, so long as bonus depreciation still allows you to deduct 100% of the value of heavy equipment purchases in the future. So next steps for people that are interested in implementing this in 2025 would be to meet with us and then we will introduce you to our tax attorney team. We just kind of have to vet you out and make sure that you're a good fit in an introductory call. But I hope this was helpful for you. We look forward to helping you out. We'll see you then.